Today's Does It Pencil webinar is a taste of Does It Pencil Course 3. Last week I found some archived video of a course I taught a little bit ago, and I went and re-edited it, pulled out what I think are the most important pieces, showed these videos, there's about half a dozen of them that you're going to see, showed them to the audience, and then we talked about them. Does It Pencil Course 3 is the tax course, and I think in terms of the value proposition of time and money, there is nothing that I've ever seen that will teach you more about what you need to know specifically about taxation on real estate investments for the amount of time it takes and the price of admission. So you can learn more about Does It Pencil Course 3 at doesitpencil.com, but for now, here's the webinar. Alrighty. Thanks for showing up, everybody. Got a lot of people today. That's cool. Thanks for showing up. Okay. So today, what we're going to talk about is taxes. And I've been doing this a long time, this talk, bits and pieces of it. And last week, I have been editing a ton. And if you've never had the experience of staring at yourself on a screen 10 hours a day, it's not for everybody. But I went through and made that sacrifice for you guys because I love you. And I was resurrecting a bunch of Course 3 Does It Pencil tax stuff. And so today what I want to do, I picked a handful of excerpts from this new alumni material that I'm going to be putting in the Alumni Center. Some of it will go on social media, but most of it's going to be proprietary. And I want to just share these clips with you, and we'll do each clip and we'll have a little discussion about it and just kind of see how it goes. But before we get into that, because it's taxes, I have a couple of disclaimers I want to share with you. And so disclaimer number one is this. If you don't have a lot of experience with taxes or tax preparation, taxes are weird. They always have been. In 1980, I think it was, I took the H&R Block tax prep course, which was a 6 or 7 month course. One of the best things I ever did. So much better than anything I ever did in graduate school and college. And I went to work for H&R Block for a couple of years and was a tax preparer. And that's when I got my first dose of, man, this stuff's weird. So if you're not accustomed to this, it's okay. All right. Take a lot of notes. The second thing is, as I've been teaching for the last 35 years of my life, and this comment applies to all over the country, New York to Miami and Seattle to San Diego. When we talk about taxes and I ask people tax-specific questions about their tax lives, it is very common for people to say, oh, I'm doing this certain thing, but I have no idea why. My CPA told me to do it. Okay, and maybe you're in that camp too, and there's nothing wrong with that camp. I just don't particularly agree with that camp. You know, all of you guys, and sort of what I say is my tribe, are small business people. And I am just of the belief that this is a big part of your business life and somewhat your personal life, and everybody should have at least a basic understanding. Okay, so that's my offering today. The next thing I want to say is when we talk about taxes in America, it's always this us versus them thing. You know, how can I save on taxes? How can I cheat on taxes? How can I pay less? How can I get away with? And that's just been the culture for 45 years that I've been paying taxes. And what I want to just kind of say as a public service announcement is we don't live in the 1100s, okay? We're more mature than that as a world and as societies. And if we're going to live in places and in countries and so forth where we're mutually benefiting from certain things, then my thing is we all got to throw in at some level. Okay. So I've never been, nor will I be today, one who advocates, well, if you can get away with it, don't pay. I'm just not in that camp. You might be, and that's cool. It's totally cool. But I like to say that first. And I'm also going to throw in, since half of my heritage is Scandinavian from Denmark, every year for probably like the last 5 to 7 years, I've been reading about this. They do these surveys once a year of the most happy people in the world, happiest countries in the world. It's always the Scandinavian countries, and it's not because of the weather. It's because they have an enormous amount of public service available, and they pay like 55 cents on the dollar in tax in exchange for that service. And so some people say, well, why can't we do that in America? Probably because we have 10 times more people that live here than in Scandinavia. And I just don't know that our government manages stuff all that well. Okay. Your mileage may vary. I think the other thing that we need to be mindful of as taxpayers is that IRS is not a perfect system. Okay. It does make mistakes. Give you a personal one. I had a one-digit filing error at one of my corporations. It was unemployment tax that we have to pay once a year. It's called FUTA, F-U-T-A, and every corporation has to pay it. And I made a one-digit mistake, my mistake, not hiding from it. I have sent 3 certified letters, talked to probably 5 people at IRS. It's taken 22 months. They've cashed the check, and they're still sending me letters that say 2 things. One day, one letter will say, we need more time. We need another 60 days. The next letter will say, US $13.82 for late filing. It is ridiculous all day long. So just remember, it's not a perfect system, okay? And my last setup that I'm going to mention here is this. This is kind of like a personal belief thing as well. All of us have a responsibility to pay what we owe, but we don't have a responsibility to pay more than what we owe. And that's the education piece. That's understanding how the system works. That's the part we talk about at Does It Pencil Course 3. And given time parameters, we'll see how much we talk about it today. All right, so we've got a series of videos to watch, and they're arranged, I think, by topic and not by length. So we'll do the first one, and then we'll see what you guys think. Okay, let's start with one of the most simplest and foundational concepts in the tax code, and that is the nature of income. And the reason this matters is because different types of income are taxed differently. So there's 3 types: active, portfolio, and passive. So active income is the income that you earn from your job. And what I talk about is your human labor. It's when you get up and go sell a house, get a commission, that's reported on Form 1099. Maybe you sell shoes at Nordstrom, you're an employee, that's reported on Form W-2. Now the unique thing about active income is it is also subject to the FICA tax, Social Security, which you can generally estimate at about 15%. Now, not all, I'm sure not all, but most of you file your taxes as an independent contractor. And so attached to your Form 1040 would be a Schedule C as in Charlie. It's a simple front and back, simple. It's the simplest business tax return there is. And if you're self-employed on a Schedule C, you also file a Form SE, which is where you report your Social Security. Okay, so if you're self-employed, you're actually paying 2 taxes. You have tax on your income and then a contribution to Social Security as well. And that 15%, it becomes a fairly big number fairly quickly. Okay? All right, so active income is the first kind of income. Second kind of income is portfolio income. Portfolio income is income that you earn passively. Okay? So this could be, for example, dividends that you earn, interest, royalties, things of this nature. So I have a fairly robust stock portfolio, and I have for a while. And so every month I get a check out of my portfolio that is dividends and interest. That money is subject to federal income tax, but it is not subject to FICA tax. Okay, there's another subset called passive. And portfolio and passive kind of commingle. There's technical definitions, I don't get into that, but I want to point this out. In the passive box, there's one specifically called passive from real estate. And that has some specific rules that I'll talk about later, okay? But the first thing you have to understand about the tax code is that there's different types of income and they're taxed differently. Okay, that's video number 1. All right, Jeff, do you have any comments on that?
Nope, good refresher. I guess my only question would be, There must be a cap on the FICA.
There is. There is. I would have to go back and look, but I think it's like 160 or 180,000.
Yeah, I was gonna say.
One of the things I talk about in the course, and I think I'm going to talk about it in one of these later videos, is it's virtually impossible to have any kind of an intelligent, adult, cogent discussion about taxation without bumping up against politics. Okay, that's just the way it is. And we'll talk about politicians a little bit here on these videos. But what I want to say now is it's an interesting thought exercise to consider, why is it that people who are making $300,000, $400,000, $500,000, their contribution to Social Security is limited to, again, I don't have the exact number, like 160,000. They stop paying over that when the system's going to be insolvent in the next 9 years. Okay. Now, I'm not here to tell you how to vote. I'm just saying it's something to consider. Okay.
I have a question, Joe.
Please.
Really quick, I do have a question. I've never researched this, but I was told that if you paid the higher into Social Security, and I've never done this, but if you paid more into Social Security, a level up, that you're going to be able to collect more. Is there a break, or is there a percentage that you can collect more in Social Security? Because I never thought it would be solvent by the time I retired.
Right.
So I never did it, but somebody told me that one time that
if you pay more, you'll have a bigger benefit when it's time to withdraw. Now, are you currently getting an annual Social Security statement from Social Security?
Not annually, but I used to. I used to get one every year.
Yeah,
but
I would recommend contacting the office in Seattle.
Okay.
And talking to them and getting that, because the other thing that'll happen is, I know you're only 35, but the day is going to come when you start drawing, right? And what they'll give you is a little bit of a chart and then like a little parabolic graph that basically says the longer you wait, the more you get. There's that as well. Okay. But if anybody who's on this call, if you do not receive annually or have never received your Social Security report, request, get on the mailing list. You should know what's going on. Okay, awesome. All right, next vid. And this one, I think we'll talk about our politicians a little bit. Certain politicians are very famous for saying rich people need to pay their fair share. Okay, or Warren Buffett's secretary pays more tax than Warren Buffett. Those are factual fallacies. They are lies on the merits. And this just pisses me off so much. Why don't you just tell the people the truth? And they don't. Okay? They just don't. And it's sad because they should. Okay? Most of us would you rather know the truth or a lie? The truth, please. Can you just tell me what this thing is? You're talking about my money, for God's sake. And they don't. Okay? So rich people pay, if they do it the right way, they're paying the amount of tax they owe. Now, that said, there are definitely tax mechanisms available in the code that are legal and legit that can severely reduce or eliminate federal tax liability. But that's just knowing the code, knowing the information. Okay? Now here's my next position I'm going to take, which you may or may not agree with, and that's fine. This is my opinion, it doesn't have to be yours. The notion that the only way you can lower your taxes, I'll put it that way, is if you hire an army of CPAs and lawyers, it's just bull. It's just bull. Come on. We live in the internet age, for God's sake. All you have to do is talk to this little thing, and it can tell you pretty much anything you need to know. It's a lack of, people don't know that they don't know what they don't know. It's an information problem. Or people just are not curious enough to ask. I've had so many clients, so many students over the years, ask them specific questions about, like, why are you a corporation? Or why are you an LLC? Just like, why are you doing this? I don't know, my accountant just said I should. And they're just fine with that. And maybe you're one of those, and that's okay, I'm not picking on you. But my argument is, at least know these things about the system
and decide if they're right for you or your clients. That's the part of why I'm here today, just to tell you these things exist, and we'll get into some of them, okay? But this is a progressive tax system. Now, the United States taxes income. If you go up across the border and visit our friends, you know, in the apartment over the garage up north, they have what's called a VAT, a value add tax. So they tax the value of your stuff. It's a completely different tax structure. The United States taxes income. Okay, and then we get into the sovereignty of the republic. You know, I've lived all over the West. So right now, I live in the state of Washington. The state of Washington does not tax income, it only taxes consumption. If you go to the basement, down south into Oregon, where I was like 4 days ago, they don't tax income at all. Oh, excuse me, yeah, no, other way. They don't tax consumption at all, they tax income. If you go to Idaho, where I used to live, they tax a little bit of each. Okay? So when you're talking to your clients, the whole interstate client thing is a whole nother conversation about taxation. Okay? Now, here's a note you can make if you want to. When it comes to state taxes, and I'm leading into my thing about regressive here, but let me just mention this first. The only way that investor, upon a sale of a property, can avoid state tax on the gain is if that investor is both a resident of a state that does not tax gains and the subject property is also domained in the state where they do not tax gains. So if you have a resident of Oregon who's selling a property in Washington, the Oregon tax agency will tax that gain. If you have a resident of Washington who sells a property in Oregon, the Oregon tax agency will tax that gain as a non-resident, part-time resident, whatever the residency thing is. So that's a whole nother deal that's more CPA-ish. I'm not going to get into. I'm just telling you, you want to advise clients, there's federal and there's state. Whenever we go to a state with no state income tax, I must just caution you, if you're working with interstate clients, this is a thing. I mean, when I first started paying state, well, I used to live in Utah, you know, you start writing those checks for 10, 20, 30,000 bucks, you're like, well, this kind of sucks. But that's just the way the state is, okay? And oh, by the way, the California Franchise Tax Board has collection offices in all 50 states. It's the only state tax agency that does. Those people dig you up your grade and pull the gold out of your teeth to get their money.
Okay. Mr. Callan, do you have any comments on the last video? You got to unmute there, sir.
I remember sitting in on one of these videos before and having a conversation about progressive versus regressive taxes, and I think that's really interesting. Question came up for me, this thing about selling cross-state. I'm wondering if you have to be aware and make the filing yourself, or if the state, more or less comes after you at tax season, so it's automatic, or how does that happen?
If you go through escrow, they will make you aware
You'll
of
get
your
issued,
responsibilities.
you'll get issued 1099s.
Yeah.
And what happens is, and Jeff, you're kind of, I think, the California guy here. I'm going to get to you in just a second. But when I was a resident of Utah, when I filed with Utah, whether it was paper or e-file, we're kind of in the transition period when I was doing that, I had to send the state of Utah my federal tax return. Okay, now you're going to get a 1099 when you sell. That's reported to the feds, so you better put that on your Schedule D, which is a part of your 1040. That 1040 is then sent to the state tax agency, and they're going to double check things that need to be double checked to make sure that they get their piece of it too. Okay, so I had a CPA many years ago say, I never recommend clients ever cheat on their taxes anywhere, but if you're going to, do it at the federal level, not at the state level, because the state will get you first. You can take that for what it's worth. Okay. Jeff, do you have any comments about the Golden State and state income tax and so forth?
I thought it was interesting your comment about the franchise tax board. Yeah, they will come after you if they
Yes.
think they can wring any money out of you.
Yeah.
They are aggressive.
My mother had a house in Palm Springs with her ex-husband, but she was a resident of Washington. And one of the biggest fights I fought after she passed away was with the franchise tax board. And they were just mean sons of bitches. At least the guy I had was. So anyway,
Why is it called the franchise tax board?
pardon me,
Why is it called the franchise tax board?
because it's California and they do stuff different.
I mean, what's a franchise about it? Is it
Doesn't matter. It means they're going to take it. I don't know
I-
why they use the word franchise. Look it up. Google that. Okay. All right. I'm going to
I
keep
had
moving
a-
forward here.
Oh, okay.
Do you, so you're quick. Go ahead.
Well, I was just going to say I had a client that actually couldn't buy a house because he rented it. He was renting in the state of California and the owner didn't pay property taxes. And they went after him and put him in collections over the owner's property taxes just because he was a renter there.
Oh my
God. What?
Yeah.
So that
yeah.
would have
He
been
was
a
a
county,
renter.
a county issue. That's a
Yeah,
stretch. I've never heard that, but
Yeah. It was crazy. And all of his roommates paid it. And he's like, I'm not paying it. And so they sent him to collections. And so he couldn't be on the loan. It was only his wife on the loan.
yeah. Well, you
It
get
was
more
crazy.
benefits if you're homeless. That's why there's so many homeless people in Santa Barbara. Okay. That was a joke, by the way. So no hate mail. Okay, let's go to the next one here.
It's the weather, Joe. That's why they hang out in Santa Barbara.
Oh, it is totally.
Yeah.
You know, I'll tell you this real quick. So the first time I taught in Santa Barbara, which is just a magnificent place, you've ever been there, when I was able to run again, when I go run a couple miles. So I'm running down State Street in Santa Barbara, like at 6 in the morning. I'd never been there. And there's all these guys sleeping in the doorways of the businesses. And I come to find out later, it's completely, this is before we had this up north. I hadn't seen this before. You know, plus people don't, there's no homeless people in Park City, which is where I was living at the time. It's too damn cold.
Yep.
Anyway, okay, moving on. All right, next.
It's a fear-based honor system. It's a fear-based honor system. Okay. I mean, that's why people do this. It's fear. Okay. But I would say probably less than 10% of the people do it the right way in this one little realm, this minutia of a realm called cost segregation. We're converting real to personal. It is tax advantageous, but you're supposed to recognize the recapture of the gain at the end. Okay, now here's the other thing to remember. Depreciation is reported annually on the tax return. Okay, it's Form 4562. So the risk that you run in not recognizing when you sell is if that gets flagged by some algorithm. Because to enjoy it as you go, you must report it as you go. And when you sell the property, there's a 1099 that goes to the IRS. So somehow their algorithm has to flag, oh wait, we got this 1099 the year of sale to get the capital gain part of the real property, but the algorithm, the AI says, oh, but they've been taking personal property depreciation 4562. Where's the recognition of that? That's what the red flag would be. So AI is awesome until it increases your tax bill, right?
Yeah, I don't know if I'm going to keep that one in the set. This was just a lot of lecture that I just cut up into little pieces, and that's sometimes difficult for me as an editor because I already know all this stuff, and I have to remember that people are watching it don't know all of this stuff. But when we were in that discussion, is we were talking about real and personal property, okay, and they're depreciated differently. So when you have an asset for business or investment and depreciate it, what happens is the adjusted basis decreases every year. So when you sell it, there's a gain. Okay. But that's only one of the taxes paid. The other tax paid is what's called depreciation recapture. And this all bleeds into something called adjusted basis, which I'll do another video on at the end here. But because we're not embedded in a full class today, I don't want to get too much in the weeds on this one thing, but I put that in the set, and I don't know that I'll keep it in there. So let's go to the next one. I am not on a mission to confuse people today, that's for sure. Okay, so this one's pretty good. This is at one point in our class, audience questions. Okay, and I put this in here. Some of these are pretty good.
What's the difference in the depreciation of personal property between the IRS and, say, King County, with when you have to, declare personal property there? Like, is it depreciated at the same rate?
Okay, I think what you're talking about, I don't work in King County, but they have you make a declaration of the value of your personal property. Okay, that's to collect a tax. There's no depreciation.
But there's a useful life on it that after a certain point, they ask you to get rid of it, or they get rid of it themselves. So they have some taxation
I don't know.
equation that they use.
I don't know.
Okay.
Ask the assessor.
I don't know.
I have a question, Joe.
Yep.
So if you say you sell a rental house and part of it is the personal property, should it be subject to excise tax and sales tax at the time of sale?
The personal property portion is supposed to be subject to sales tax. It would be immune from excise tax. You would have to call that out in the purchase agreement.
But the IRS doesn't enforce that kind of or nobody, does that ever come up in transfer of property?
Well, excise tax and sales tax is not federal tax, it's state tax.
Right.
I've never seen anything in a contract in regards to the personal property being the sales tax being in there for personal property.
No, you don't talk about the tax, you talk about the allocation, and then the closing agent is supposed to collect the tax accordingly.
I don't think I've ever seen that in a settlement statement.
Oh, you mean people didn't declare? That's weird.
Is that normal? Am I the only one?
Okay, so I'm a commercial guy, and so I've been doing this a long time. And in the SEBA purchase and sale agreement and a property drafted purchase and sale agreement, I sold a 10-unit apartment building like 4 years ago, and we declared a value of, it's called FF&E, fixtures, furniture, and equipment, of $100 per unit times 10 units. So the closing statement reflected, $1,000, $100 of conveyance tax on personal property. Look, I'm not saying everybody does their paperwork the right way. I'm just telling you this is what it's supposed to be. And again, if you don't get caught, you don't get caught. I saw a deal one time. I was in this hotel in Florida. I was watching C-SPAN. I was a little hungover, but I was watching anyway. And the guy that ran the IRS at the time was appearing in front of some congressional committee. And this was very interesting because I pay attention to the tax stuff. The IRS guy goes, "We collect tax at an 87% efficiency rate." And of course the congressmen are like, that's BS, and it's gotta be more than that. He goes, "No. Why 87%? Because at a level of 87% efficiency, anything more than that, it costs the IRS more than $1 to collect $1.
Interesting.
Do you think that the smartest tax minds in the country work for the IRS? Do you really think that? Most of the high-up guys I've met have like junior college accounting degrees. And I'm not belittling, I'm just saying. It's a really interesting war, and it is a war.
It's a puppet job. Puppet.
So
So I have a question on a little bit different. Let's say you buy a property and you set about fixing it up so it's real property, and you're putting $50,000 worth of improvements in it. But but you're installing, let's say it's flooring or cabinetry or what have you, you're doing that yourself rather than hiring a contractor to do that. Are you, I guess it's.
You don't get to
I know,
depreciate
but
your own
it's still
labor.
worth asking, can you claim any of your own labor to do the work, or it has to be through a contractor where you're getting receipts and such?
Well, you get to depreciate the money that you pay to create the basis. So, I mean, if you're going to do that, I guess if you are going to, and you want to do it the right way and create the paper trail, then you would actually write yourself a check for the labor and make a declaration of it as income, pay the tax on that, and then it probably would be deemed eligible.
Okay.
Why one would do that, I don't know, but I suppose one could.
Okay, I thought that was a video with some utility because the kinds of questions that came up were very common in the live courses. Now, again, we're in a webinar today. This is just kind of me throwing stuff at you. We'll have a little bit of discussion. This is not a class where I'm teaching you or taking copious notes and that kind of thing. But I think that the summary statement that I'd like to make about what we've watched so far would go something like this. This was a class that focused on real estate held as an investment, not commercial real estate, any kind of real estate held as an investment, okay? Piece of land, condo, single family, duplex, commercial, it's all the same. It doesn't change. And as we look at the tax consequences, these kinds of sales, people have a lot of questions. Okay. Now, look, I've been doing this a long time. Many of you have been doing this a long time. And there's nothing wrong with, and you should, the client should defer to their licensed tax advisor. There's no doubt about it. What I'm trying to do is to give people a basic understanding of this is how it works, but more importantly, this is how it's supposed to work. Because there's just a lot of bad info out there about all this tax stuff when it comes to like real versus personal, recapture of gain, excise tax, sales tax, tra-la-la-la-la. It's a lot of stuff. Okay, it is a lot of stuff, but it's important. And my thing is, if you're going to sell investment properties or be an investor, this affects things. You need to know what this is. Okay, I'm just going to pause there for a second. Elizabeth, haven't seen you for a while. How's it going?
Good. How are you?
Oh, just
I know it's been like 10 years.
I know. Yeah. So what do you think about this so far? What's your experience of the last 40 minutes of your life?
I'm just absorbing it today.
Okay.
So some of this is not stuff I deal with on a regular basis, but it's never hurts to know more.
Yeah, that's an excellent comment. And like anything else in adult life, if you don't do it on a regular basis, you're going to forget. It's just all that kind of stuff. Okay. So for sure, repetition, if this is going to be your wheelhouse. Okay. Kelly Ham, what do you think about this so far?
It's complicated, all the tax stuff.
Yeah.
Yeah.
Okay. Fair enough. All right. So this next video is going to talk about depreciation, which is something that we talk about quite a bit in Does It Pencil Course 3. Now we're going to talk about real estate depreciation, but let me just make this general comment about depreciation globally. If you own a business or own real estate and you're looking to decrease your current tax liability, using depreciation is the most effective way to decrease taxes due, both at state and personal or federal level. Okay.
Can I ask a question about that?
Yep.
If you don't take that depreciation, which lowers your tax bill eventually when you sell it, how do you?
I get this question and I've talked to people about it, and I've just heard the craziest stories from some of my students over the years, especially in Orange County for some reason. Orange County has a strange thing going on down there. But anyway, I I'm not going to answer the question specifically because that's a specific circumstance question that oftentimes has a lot of other information attached to it that I don't know. Instead, what I'm going to say is this: you're supposed to take it every year. You're supposed to recognize it. Okay. Now, in course 3, we talk about what are called the passive loss allowance rules from real estate activities. That's a whole talk that I do in that course. And the effect of using depreciation to decrease taxable income, it's kind of a trickle down on what we call the cash flow worksheet. So there's other things that affect it. And the point is, when you get to the end of all of the stuff, of which depreciation is just one of the lines, there are specific rules that can you use your losses in the year that you acquire them, or do they become what's called suspended? Okay, now again, well beyond the scope of this discussion, but as a general question to your, or answer to your well put question, I'm going to say, just take it as you go, recognize it when you sell. That's what you're supposed to do.
I mean, I liken it to a Roth IRA versus a traditional IRA, you know?
If that works for you, then liken it that way.
Well, I mean, I'm just curious. I have a client right now that is going to pay a massive amount of capital gains, and she's doing she wants to do a 1031, but she hasn't listed her property yet we're under contract with her new property. So I guess she'll do a reverse.
Yeah. Have you talked to a 1031 exchange facilitator about that?
Yeah, absolutely. Yeah.
Okay, good.
Deep conversations with her CPA, but we've just kind of gone about it a little backwards. And her capital gains, if she doesn't, get the other one sold in the right time frame, it's going to be huge.
Well, the code allows for
you didn't take the
reverse exchanges.
Yeah,
you can do those, but the rules are tight. There's not a lot of wiggle.
Yeah.
Okay. So good luck with that. Okay, let's check out some depreciation stuff.
Depreciation. Here's some very important notes to make about depreciation. They're also in your book. Number 1, depreciation is a tax world concept and not a real world concept. So if you haven't been around this tax stuff before, it seems weird. And just be okay with that. It's a new topic, it's a new concept. It just takes a while for it to soak in. All right, that's the first thing. Here's the second thing. You cannot depreciate land. You can only depreciate the improvements, the real property on the land. Okay, land is not depreciable, and I'll show you here in a bit how we do that calculation, figure that out, but you cannot depreciate land. All right, third thing. Depreciation is a non-cash expense. It is treated as an expense on a tax return, but you do not write a check for it. That's why it is tax advantageous. Now, see if you can follow my stream of consciousness on this, okay? I'm an investor. If I have more depreciation, I have more non-cash expense. That expense is applied against taxable income to reduce taxable income on a tax return. When I reduce taxable income, I, number 1, reduce the amount of income subject to the tax, and number 2, lower my bracket in a progressive system, meaning I pay less tax. When I pay less tax, I have more of my own money left over. So that's how depreciation works. It's a non-cash expense. I apply it against income. It decreases taxable income. It also lowers my bracket. Therefore, I pay less tax. Therefore, I have more of my own money left over to spend. That's how depreciation works. Here's the next thing to remember about real property depreciation. There's a couple things. Number 1 is the method that we use to depreciate real property. It's called the straight line method. And what that means is, once you calculate the annual depreciation, you take the same amount each and every year, with 2 exceptions. It's prorated on a tax return in the year of acquisition, and it's prorated in the year of disposition. And it uses a tax terminology in the year that you buy it and the year to sell it called mid-month convention. What is mid-month convention? Well, what mid-month convention is, no matter what day of the month you buy or sell the asset, the IRS assumes it was the middle of the month. So if you buy or sell in August, doesn't matter what day of the month it is, they just figure it was the middle of the month. That's called a mid-month convention. Now, if you depreciate an automobile, that uses something called a half-year convention. So it's even broader. But for real property, it's a mid-month convention. We don't do mid-month convention calculations in Desert Pencil because it's just an extra step. We're just doing worksheets. We're not doing tax returns. Don't worry about it. If you look at a tax return, just remember, in the year that you go in, year you come out, it's mid-month convention of the annual depreciation. All right? That's the first thing. Second thing is this. The depreciable life of the asset, it's a new term for you, the depreciable life depends on how the real property is used, and there's two categories, residential and non-residential. Those are the two categories for real property to enjoy straight line depreciation. So what is residential? What is non-residential? So I define residential this way. There's two criteria. Number one, you can sleep in it legally. All right, so it has all the accoutrements of a legal dwelling. Okay, you know, the bedrooms have a closet and a window and a door. It's got a bathroom, it's got a kitchen, all that stuff. That is the components required to make it a legal living dwelling unit. And number two, the leasehold interest of the tenancy is 31 days or more, or 30 days or more if it's those 2 months that have 30 days. Now, why do I say that? Because technically, any kind of a tenancy that's less than 30 days is called occupancy by license. Like you stayed at a hotel or a motel. You have a license to stay there for a night or two, however long you're staying. But that's different on the tax return. If you want residential treatment, the leasehold interest must be 30 days or more. Okay? If your property is considered residential in the tax code, it's depreciated over a 27.5 year useful life. If your property is non-residential, meaning commercial, it is depreciated over a 39-year life. I'm going to pause there for just a second. So you probably realized, as a lot of the audience did, is that there's a lot to know when it comes to real estate taxation. But as I said in the webinar, this stuff isn't complicated, and it's really important because it tags a lot of dollars from investors. And you have to understand how this thing works so you can plan to be the most tax efficient. All right? So if you want to learn more about taxation, real estate investment, check out Does It Pencil, Course 3 at doesitpencil.com. Thanks.